I feel super strongly about this point, and it's that scarcity drives innovation. The constraints provide those opportunities to think differently. If Amazon had unlimited access to capital, would they have built AWS? I think there's a role for your $20 million venture fund. I think there's a role for your $50 billion venture fund. But we can stop pretending that they're doing the exact same thing. I think that the real thing is the biggest outcomes are really fundamentally unique enterprises that can create long-term value. And those businesses need to find the right capital at the right time to meet the underlying business needs. If you're just raising it because it's there, that's a problem. I don't know what the future is going to look like. I know it's going to be really dynamic. And I want to find the kinds of people that are up for that challenge and can ride that wave. And I'm really excited by that.
So those founders that you're talking about, I've heard you say there's a couple of things that you really look for. Learning velocity, calm decisiveness, disciplined adaptation. Stack rank those for me. Which ones are non-negotiable? Which ones can be learned?
So there's a lot to unpack there. One,
Hey Climbers, welcome back to this episode of Climb. I'm Jake Kapoor, General Partner of VSC Ventures, and I'm your host on Climb today. Today, my guest is Emily Melton, who is the co-founder and managing partner of Threshold Ventures. Threshold invests at seed, Series A. They are one of the most disciplined funds that I've seen in the industry, and that reflects in their fund size. They've raised 5 different funds that they've invested across all around the $200 to $400 million space. Emily, in particular, has experience investing in healthcare AI back before it was called healthcare AI. So we're going to dive into some of that. She's also been the board chair of the NVCA. And so I want to talk to her about what she's seeing in the market today and what it really means to play the game on the field. This is a really fun conversation with somebody who has been in venture through so many investing cycles. And we're just so grateful to have her experience on Climb. Emily, thank you so much for joining me.
thank you so much for having me. I'm excited to be here.
There is so much I want to chat with you about, but maybe we lay the landscape for listeners a little bit. We're chatting at the beginning of April 2026, and the power law is more power law than ever before. I mean, just to lay the numbers out, 83% of venture capital in the last year went to 3 companies, 41% of it went to 10, and 75% really went to 20 companies. I mean, the heavy concentration in these big names. What specific moment, as somebody who has invested through many market cycles, did you look at the market we are in currently and go, yeah, something's different?
I also shared those stats with my LPs, and they've actually only been getting bigger over the last 12 to 18 months as that concentration has become more, and trying to think about what the overall impact of that is. There's lots of micro moments, but I do remember one moment, a founder that I deeply respect, I've worked with and seen do amazing things, is raising a round and was gracious enough to come talk to us. But he was raising $1 billion. They had some individuals who had signed up but hadn't actually started working, still had other jobs. Nothing had been built. There wasn't really a deck. It was a 1-page memo of the vision. And that was oversubscribed pretty quickly and at a pretty high price. And it was one of those things where it was just all my fundamentals. Like I was at the end of the 2000.com, so when I was at Draper Fisher Jurvetson, but things got ahead of themselves, but they're still tied to some level of like the reality. Like the eyeballs were then going to be monetized. There was metrics. 2021, when there was like you had money was free, and so everyone was paying huge prices, but that was based off of like this idea that those multiples were going to continue for perpetuity. And so this was the first time which it just felt like it was the promise alone was being underwritten, and the success was already going to have to be, I mean, at a minimum, $20 billion.
Yeah.
Right. So I'd never seen something like that or thought at that scale from day zero. And trying to work backwards and understand what the implications of that's going to be.
Yeah. Look, you're in the business of finding and backing great entrepreneurs. And great entrepreneurs also know how to run really competitive rounds today. So as somebody who's been 11 years, the median price of a seed round that I have seen from when I was a little baby associate to now running my own firm has more than 2x'd. We're seeing at YC, the entry price is 4 on 40 for companies coming out of their latest batch. When you see these mega rounds or these crazy entry prices on the first round, what's your impression? Is that like, okay, well, that's not really our strategy, it's not for us, or are you feeling the competitive edge to want to go and and be a part of those as well.
Yeah. I think, well, in instances where you're underwriting, it's $1 billion first race. Like it's kind of easy because we can't even play, right? That doesn't even make sense for us. Those are great opportunities if you have lots of capital to put a lot of capital to work. You have to play the game that's on the field. And so I don't think I've ever been in venture where people are saying this is a great time to invest because all the valuations are rational, right? I've never seen that. So everyone's always has a right to complain at any given moment.
Yeah.
And then the best companies find their ways to navigate it. And then if you choose the wrong ones in that environment, you're in trouble. For us at Threshold, I think there's the benefit of being a constrained investor, meaning that we only have a $350 million fund. We can only write certain size checks. Like we can do entry, a couple $1 million up to like a $15 million in the first fund. And we'll do that across seed through Series A, sometimes Series B. That means that there's a lot of things that I don't have to spend my time on. Like I don't have to go and try to chase the mega rounds or get access or squeeze in. And so that constraint is actually, I think one of our superpowers is just knowing where we can play and how we can invest. We don't have minimum investment like thresholds. We don't have minimum ownership thresholds. That's not to say we don't try to look at this and say, do we think this is a big enough market with a meaningful enough founder that has the opportunity to return the fund? Yeah. That's kind of how we think about what has to be true for this investment opportunity to be a meaningful contributor to a $350 million fund. Mm-hmm. In some ways, that's easier for us because a $350 million fund means we have lots of opportunities for that to be meaningful. A $3 to $5 billion company could be extremely meaningful. Yeah. Whereas for some companies, you need to have it be 10, 20, 30 billion, especially at some of these enterprises. So I'm not jealous or, sad or frustrated. I kind of flick out the market and say, okay, this is actually an opportunity for me to be more focused, and that constraint is my superpower.
Yeah. I think in some ways there is a different product being on offer, right? There's the product of the $300 million fund and the entry prices you're offering. And then there's the multi-stage, multi-sector, multi-vertical product that some of our colleagues and bigger firms have. Now that they are coming down to seed and Series A, how does that affect how you compete to win?
Well, I think there's two things about those. Those are the products and price, right? And so market sets price. Let's be honest. And you can maybe get an argument where you get a little bit of a discount on price because of your product. Yeah. But there is a market force of price. Okay, and I think if someone comes and says they're going to be able to completely be the market maker, those can be really tough. I was listening to a podcast where said, I don't look for diamonds in the rough, I just look for diamonds. And I was like, that resonates. I get it, because those are hard. Like, I think when price is driving it, particularly in a competitive market, that by itself can be the false flag. I think we do see a lot of different people. There has been a proliferation. When I started, there was no seed funds. It was friends and family, and then you raise money. Yeah. Right? And then YC was amazing. And now you see YC, Neo, South Park Commons. There's this product that totally exists at the early stage. That also the seed investors. It's always becoming more and more competitive, and there's more and more kinds of opportunities for entrepreneurs to figure out what's the right capital partner I want for this company at this stage. Mm-hmm. And for us, I have dinner with every founder before I put a term sheet down. Right? If I don't want to sit with the guys or the gals for 2.5 hours, then I probably shouldn't be on their board. I probably shouldn't be their investor. Yeah. Right? And so that doesn't always scale. That's part of that component of it. But we try to build that personal relationship. Some founders really want that personal relationship. They want to know that if they call me on a Friday at 8 p.m. because they're freaking out about something, I'm going to pick up the phone and I'm going to have that conversation with them. And they reference that. And they talk to my other founders and they tell stories of when I have helped in those darkest moments. Or when I have also been helpful when there's things that are going great and they needed to find that next round or close that key candidate. And so it's not the product for everybody, but for the right founders that want to add that to the mix. Mm-hmm. That could be that they've also had, one of the larger funds on it with a more junior partner that is helpful in giving them capital, but doesn't actually have as much experience. They also may want the bigger funds at the time that are going to have access to whole relationships that I don't have. I just don't view it as zero sum. Yeah. It's am I meeting the founder at the right time when they want me to be the partner to help them? Yeah.
So those founders that you're talking about, I've heard you say there's a couple of things that you really look for: learning velocity, calm decisiveness, disciplined adaptation. Yeah. Stack rank those for me. Which ones are non-negotiable? Which ones can be learned?
In this market, more than ever, the learning, that learning velocity is critical. It's fundamental. I think the other two can actually be taught over time, right? As you mature, as I have, the enhanced blonde covers the grays. I have also become a little bit more calm and decisive as I've aged. You can learn how to do some of the other and get mentored in them. I think it's really hard to coach someone to want to be an innate learner, innately curious, right? That's not something that There's nothing you can say, hey, go and read this. They have to want to read it. The best founders I find are obsessed with whatever the problem is that they're solving and are always looking for new opportunities and are always questioning their assumptions. And in a market today where the technology is changing so rapidly, the regulatory environment is going to change so rapidly. Like everything, literally, I feel like it's there's no assumptions anymore. This is like the worst market in the world to use analogies, right? Like I've seen this so many times. These investors, it's like the Uber of X. And I was like, I've always hated them. 26 years I've hated analogies, but now more than ever, it's first principles thinking with adaptation because everything is changing.
Yeah.
I saw this that, it's like the movie Interstellar, one day on the planet is like, like years and I feel like a month in venture in 2026 is like a year in 2014 or 2015, right? And so you have to have the founders that are willing to actually adapt and move to that change and make the right for their businesses based off of the fact the market is changing so rapidly.
Yeah, I'll completely agree with you there. My favorite thing is when I go and hang out with some of my friends from high school who are not in tech and venture, and you're talking about some of the things we're seeing in AI, and they're like, you can do that? I just talked to ChatGPT about like things in my day. And you're like, yeah, dude, like we are so early in that process. And to your point of like the velocity of things accelerating, it's hard for everyday people to keep up, but even hard for founders who are maybe building in the last generation of SaaS to adapt and understand what they're doing. Can you give me an example of when you saw that learning velocity in action? Maybe it was the first meeting or a diligence process when you, like, what does it tangibly look like when you're in the room with somebody?
You can just sense a founder. A lot of the times goes when you ask them questions and you see if they're trying to just get through it to get your money or if they actually really want to be probed and questioned. And you also get the sense when there's founders that like just I know what I'm going to tell you and like get out of my way. And some of those can also be curious in their own right. They just don't actually respect your intellect, which I've seen. But I remember even when we first met, this is a long, long time ago, but one of the things that really struck about Aaron Levy at Box, when we met him, he was sleeping on a couch, Mike Arrington's house. There wasn't a seed environment at that market, right? Like this is like the idea that you drop out of college and start a company in, 2025? Like that was not, or 2005, that wasn't something that you did. And we had a lot of questions when we would meet with him, and he would always come back, go off, and then come back with these very detailed and thoughtful responses. And you just got the sense this is a guy who's just always kind of trying to iterate and learn. Another one of my just favorite founders I've worked with was Akshay, who's now the founder of Notion. I invested in him when he was at a company called Pulse. He was 21. He was just out of Stanford in the design school. And he embodies that kind of calm, discipline. But he is just an innate learner. And everything, you'd ask him questions and he'd come back and he had read all these books and had notes and was just so thoughtful and had just this veracity for information and retention of that information that I had never seen before. You just, when you experience it, you kind of know it. And it is really distinct. They're just operating. It's almost like they were ChatGPT before I was. They were operating at a different level of intelligence, or that you then wanted to see and know that those individuals are going to be superpowered.
Yeah. How does that show up when you are on their boards? I've sat on a few boards as an observer before, but in our current model, we don't take board seats. And so I'm always so fascinated to understand the dynamics of that. You're coming in super early. You may be their first board member, but you're going to add more board seats as you go along, more ideas around the table. How do you see your role on these boards in both enabling the founder, but also challenging them to go further?
Yeah. The most intense conversations I've had with some of my founders are usually not in the boardroom, right? They're prior to a board meeting in preparation for it, after the board meeting and processing it. So I think like you see how I think the best founders run their board meetings in certain ways. Okay. Maybe as a different like repositioning of the question, which is the worst boards are ones that are just, everybody is like just regurgitating the information that was in a deck. Right? It's a show. It's just like you're walking through this. This meeting should have been an email. Or worse, like people are not prepared for the meetings, and so they're asking questions that aren't there that they should have been able to actually easily address. So I think the best founders that I've worked with, they presume that everybody has actually read the materials, and it's like the basics, or they call and make sure everyone doesn't have any questions on the kind of key things that are not strategic questions, that are just tactical questions. And then they pose it where there's 1, 2, usually at most 2 real strategic questions that they want to have the board address. And that they get a collaborative discussion. And they're not looking for the answer. The answer doesn't come out of that meeting. The purpose is to take this unique set of people and push your thinking to help you and the team get to a better answer. It's an evolution for a lot of founders, and to get the confidence to be able to do that. And also to have the right board members. As we talk a lot about founders, there's good and bad board members, right? Good board members know that what we're there to do is to push and, try to support the founder or as the CEO. And if they're not making the right decisions, you as a board, it's not to tell them what to do. It's like, you got to replace the CEO if you don't trust them, or you got to empower them to be better, right? So if you have a board where they think they're going to be driving your strategy or telling you what you need to do in product or telling you what to do, you've got a bad board member if you've got a bad founder CEO. If you actually have a dynamic where everyone is trying to learn and listen to enable and empower the founder and that team to be as successful as possible, those are the best companies that I get.
Do you find the founders are coming in with their mind made up and are there to kind of convince the board, or do you find the best founders actually there to get the insights?
Yeah, it's like talking to people about their marriages. Like you don't say it's like, here's how you have a happy marriage. Like, there's 2 unique people that come into something and do it. Take that and compound it infinitely, and that's the founders. Different founders operate in different ways, right? I can tell you some that are wonderful at driving that consensus. There's some that want to be pushed in their thinking. There are some that come in with very strong opinions and only are going to listen to a couple people. We say in a lot of our role at Threshold is not to say, here is a Threshold founder. It is to say, here we find the right founders and how can Threshold best support them? How do we meet them in the way that they need to be successful? Because, and this is true of everyone, whatever is your superpower is also almost always your biggest flaw.
Say more about that.
Meaning if you're the best storyteller in the world, you can sometimes believe your stories and not be based in reality. So you want to have that because that opportunity is amazing, but then you have to make sure there's people that can hold accountable for the reality. And so always that yin and yang of supporting what they are. Some of the best people I've worked with, they know that innately, and they find the co-founder or other executives that help complement them. And they know that they need that foil to be their best selves. And so that's one of the things you look at is what is the superpower? And then how do we both enhance that superpower, but also mitigate the potential downsides of that?
I see this a lot too, where the founder, when the incentives are to maybe go raise more money, to grow faster, to maybe raise more than your current dynamic of the business would suggest. Are you in those rooms where you're being the voice of dissent and saying, hey guys, maybe we're not ready, even though going and taking that additional round of capital would be a nice markup for everybody? How do you balance sometimes those different incentives?
Well, I really hope in a board meeting you're not thinking about markups, right? Just being if somebody is actually optimizing for that or they have that on your board, you want to rethink that. I think one of the things that people don't spend nearly enough time really looking backwards and analyzing is the messy middle, right? Most of the best businesses aren't just perfectly up and to the right. And maybe I get to benefit from that because I did start in the industry when I was 22. I was so young at Draper Fisher Jurvetson and did get to see so many of those messy middle companies. Tesla, it was funded. It wasn't even Elon wasn't the CEO, but him taking over and managing that through the financial crisis. Let me point out SpaceX. They had 5 years where they weren't growing revenue. Right? They actually had a year down there. So I think sometimes it's it's not just raising capital because you can raise it or if you're playing in the financial game or everyone's trying to think about things just as financial investors. And I do worry a little bit more about this in this market because there are so many people who are thinking about it in terms of their own fund or their own returns or calling all this, interim stuff like liquidity because there's, I think that the real thing is the biggest outcomes are really fundamentally unique enterprises that can create long-term value. And those businesses need to find the right capital at the right time to meet the underlying those business needs. If you're just raising it because it's there, that's a problem, right? And that's not just a board problem, that's probably a founder problem. How does the founder have the discipline? How does the team have the discipline to make sure that, they're raising what they need to be able to meet their goals? It's the capital is a weapon that started with the old SoftBank, right? And then you were seeing this from the Uber Lyft. I've had to really kind of rethink that. It's challenging right now, right? Because there's some businesses where I actually think it's really detrimental, and there's some businesses where I understand it's core. but I don't know if it's building the moats that they think they're building. And so you really, I think that's the big, maybe $1 trillion question is what are the ultimate moats and how much are capital enabling those moats or not? But there are real needs for dollars here that weren't true in the software era and definitely weren't true in the first era of the internet.
The counterpoint that a founder would offer right now is like, well, it is a gold rush and we want to be the number one player in the market. And if we don't do it, our competitors will. And so now you start to see multi-billion-dollar rounds and, legal AI or whatever you pick your vertical or pick your sector. And we saw this happen with Uber and Lyft. We saw this happen with Rover and Wag. You mentioned, SoftBank as an example. Yeah. This repeats itself. And I've been in this industry a decade to see it repeat. You've seen it repeat even more than that. Is it just the moment that we're in where founders feel
I think that the Uber, Lyft, Wag, those were customer acquisition vehicles, right? Like, didn't we love it when we could take an Uber and it cost like $30 from the airport? Fantastic. And now it costs $150, right? But Uber has a market cap of $150 billion because they leveraged that and then actually increased prices and built that value. So there was kind of an arbitrage of capture and move on. That's not that analogy, and the analogy that doesn't hold true today, right? Okay. Because it's not like when you have the network effect businesses, every single time they got a driver and a user, that benefited that lock-in. Yes. Right? I'm using ChatGPT, Claude, Grok. I use all of them, right? And every time I use it, it's not that every additional user increases the value. Every additional user also increases the cost. Yes. Which is why, OpenAI had to shut down Sora, because that's a cost vehicle that wasn't driving the revenue. And so I do think that these models, they're evolving. And so I think you have to, it's not a industry-wide thing you can say. It actually has to be kind of first principles on a per company basis. Yeah. Does this make sense for this company and this founder pursuing this strategy? But just capital for capital's sake, I reject. I've also heard so many founders say, well, we'll just raise it and we won't spend it. And I've never seen that happen, right? That's just not a thing. So if you raise it, you better have a reason to spend it that's going to be, creating enterprise value long term.
Capital solves some problems that could be solved with creativity, right? I think about go-to-market as a good example of that. If you can go raise a lot of money, you don't have to get creative about building communities or building content or developing a newsletter. You can just, brute force it on ads. And so we miss that sometimes when we say just because the capital is cheap, and again, we can define if it is cheap or not, right? But just because the capital is there, the founder may block off a part of themselves or the business that would be creative otherwise.
I feel super strongly about this point, and it's really hard to articulate. And that scarcity drives innovation. The constraints provide those opportunities to think differently. I remember sitting with a very senior exec at Amazon, and this is in the 2021, 2022, where capital we thought was crazy, nothing compared to now. And he was saying that, look, if Amazon had unlimited access to capital, they'd gone public and they were would they have built AWS? Right? Because you could have, if you just had unlimited money to rack servers and it didn't matter. Would you have had that constraint where you were trying to take what's a cost center and make it something that could actually generate revenue? Think about how different that business would be if you didn't have that. I think another really great example is, Elon initially funding SpaceX, but then getting investors. What was the big paradigm shift that he had that he needed to make rockets more capital efficient? Reusable rockets. Right? That is the value proposition that led to Starlink to do it. If you just had unlimited capital and you're just going to be better than everyone else who's doing it, would you have actually rethought the entire delivery mech? Would you have done that work? I don't know. But I think that those constraints, even in really capital intensive businesses, this is a big e-commerce businesses, so let alone the ones that don't require as much capital. I think that's one of the questions that we're going to look back on and say, did we drive the best innovation with all this capital or not? And there's a lot of interesting stuff going on in China. And I remember DeepSync was this moment, and then we kind of stopped talking about it. But if you read about China, it's really interesting because the government is essentially funding it, but they do it in a competitive environment where they want to fund a lot of companies that have to compete for that scarce resource and drive on that innovation edge. As you said at the very beginning of this podcast, we're making kingmakers. We're doing what you think the dictatorship would do, is we deem the winner, where another country is taking a very different approach. And I think we're going to see which ones actually build the best models, which ones build the strongest and most durable companies.
Your point about the government intervention, and this is actually a good segue to talk about healthcare, which is a space that you spend a lot of time in, and one that I feel like has fallen out of favor with investors in certain categories, especially biotech, but is starting to see interest again with AI. You've been investing in these categories, bringing AI into healthcare before it was even called healthcare AI. So talk to me about where you have seen implementations inside of healthcare, health systems, doctors' offices work, and where do you feel like founders building in healthcare AI most often get stuck?
There's kind of two ways I would take that. One, it's really funny. AI, obviously, there's machine learning and deep learning and then generative AI. And I've kind of joked, I'm not sure generative AI is what we want on at least for your doctor. It's really like, especially as you think about where I think the biggest opportunity is clinical workflows and diagnostics.
Yes.
There's huge opportunities there. I'm an investor in a number of companies, and we actually saw this coming out of some experience from DFJ with Tesla in seeing what they were doing on the deep learning, the visual models, really knowing that this is something technology could be able to read X-rays and images better than humans. That's been true for 10 years, right? I've invested in Viz.ai, Imagen. I have companies that got de novo applications through the FDA to use deep learning AI to do diagnostics 8-9 years ago. The challenge was the market wasn't ready. And there's like everyone hearing, not believing, we don't know what AI is, we don't trust it. And then how do you actually embed it in the workflows? How do you actually bring that to market? And so for some of those companies, you had to find your wedge. Viz did it through a breakthrough status, very specifically in stroke and building workflow that worked within health systems. For Imagen, because they're actually trying to do the full stack diagnostic suite on imaging, it was harder because you go to health systems and they just didn't know what to do with you. And selling the software, and they didn't want to run the software. How would that work? And so what seemed like a real challenge has ended up being the opportunity, which is we had to build the entire stack ourselves. And we brought it to the market where it was net new. So large primary care groups. We brought, Optum has some of the largest primary care practices in the country. They're running on Imagen, where they're able to now get the mammograms or those diagnostics turned around in terms of days versus sending people off to health systems and not knowing what's actually happening. That learning helped us prepare for what we're now seeing, which is a massive pull from the health systems. But the health systems don't want a software. They want a solution. They want you to be able to come and take that, which means you have to have some of the services. You have to have that full stack approach. That was true of how Palantir broke into the government. They needed a full stack solution. And so I think in healthcare, particularly in the diagnostic side in general, you're going to see these different models that, again, there's no analogy. I'm not going to say it's this or this, but I think those are going to be some of the more interesting businesses. The other thing we're seeing in healthcare AI, which is where most of the venture funding has gone to date, it's the first time I've been doing this for a long time. And I remember even at DFJ, we did Athena and Hippocrates. It's product-led growth in healthcare. That doesn't happen. Like doctors haven't got to do that. And I think it was just out of desperation because there was no good tools that you saw scribes, like things like Open Evidence, these tools that they're adopting themselves. Now, that's amazing. And thank God we're finally giving doctors something to be happy about because they've had to go through hell. And these people who learn how to actually treat humans have had to become data entry monkeys, which is not fair. So I think that is a big opportunity. But the next level is you can't just give them these one-off you need to be integrated into their workflows, which means you have to figure out how to get the clinical data. You have to have that more holistic solution. And I think that's where the next wave is going to come.
This is how I knew AI and healthcare was starting to take off. It's on this season of The Pit. I don't know if you watched that show.
No, is it?
It's fantastic. One of the doctors comes in and she's complaining about charting. And she's like, well, here's an AI charting tool. And I looked at my wife and I go, they're talking about AI charting tools on the season 2 of The Pit. So it's having its moment, I guess, is what I would say.
I think that's really exciting, though, is that I think that's fair. When people can experience what a ChatGPT or as a consumer, what it can experience in their real life, and then to act as doctors who are doing some of the world's most important work, to suddenly have to only deal with tools that are 20 years old or 15 years old, that discrepancy was going to break, right? And so I think I believe fixing, we talk about like the healthcare and AI as a cool sector or not, like just zooming out with the baby boomer aging population, looking at our budget, this is a social, moral, economic, political imperative. We figure it out. And I do believe that what AI enables would largely is to actually create better healthcare services at lower cost with better outcomes.
For the founders building these categories, though, you talked about this services model, right? kind of a dirty word in ventures, and you go, oh, okay, now we're going to go from 80% software margins all the way down. You used to have founders that started with, well, our margins are 30, they're going to go to 60. Today, you're starting with founders going the other way, starting at 80 and realizing, oh, actually, we need services. Or, gross margin is 80%, but by the time you get all the cost in there, this is a cash-burning business. How do you think about those things? Is it too early at the stage you invest to even worry about that? Like, what's the margin profile look like in these businesses?
It's funny. I think one of the important things for us to know is we don't know. Like, these are whole new businesses, right? And in the businesses you're investing in, electricians and empowering those, like, is it a software business? Is it a service business? I think it's going to be a whole new category. Yeah. Right? Like, we got used to SaaS and believing what SaaS was, and then you realize, like, stock-based is costs all this stuff. Like, some of the investors aren't as happy about it. I think that hybrid, that it's not a pure services business and not a pure software business, and how does that get optimized, is something that we're just in the very, very early stages of. Yeah. There are some historical analogies where you can bring in the software or the services and then leave the software behind. Like, Palantir has done this. Look at Palantir's margins. Mm-hmm. Like, now everyone's FTEs, fancy word for consultant, but like, they brought that in, and then you see the margins progress over time. That's true of like old Workday, Viva. Half of their businesses are services in the early days because they required that change management to get their customers on. And then the software, they progressed to be those higher margin businesses. I think for a lot of the $1 trillion services industry, it's going to look something different. Like, I don't think it's going to just end up looking like a software business at the end. I think what we need to start to do is something that, especially venture investors in the last 10, 15 years, because we all got so used to like rule of 40 and like feeling like we're so smart because of the software. We just plug it in and it works. Like, the irony is at the moment where you have ChatGPT, you're probably in the worst position, or Claude, you're in the worst position to put the business model in it and tell you how to work, right? Because it's going to be something that they don't know. Yeah. There's no analogy or paradigm to look at. I think it's like, is this a business that's going to be profitable? Is it a large enough TAM? Are you able to offer these services and softwares? Are you able to scale and do it profitably? Yeah. And I think that last piece is that whether that's a software business or a services business, I think we've lost a little bit of that discipline or understanding, which is you can zoom out. It can take a long time, but SpaceX, profitable business, right? Controlling your own destiny. Notion, we talked about Akshay, they were profitable to control their destiny, to optimize. So I think having at least some understanding of, we may not be profitable today, but what does it look like? What does end state look like? I think is a really important thing we need to start to look at. It
brings us back to the beginning of the conversation where we said, what market are we in today and what are people optimizing for? And we're in a market right now where LP capital has gone out but not come back in. We thought IPO market was going to open back up, and maybe it will. We're seeing the news of new IPOs slated for this summer and later this year. But in the moment, what I am seeing at least is that access is the most important thing to LPs right now, and access into increasingly fewer and fewer names. So when I hear you say something like, well, venture was built on discipline, venture is a get-rich-slow scheme, right? All these things. You have investors today that are going, yeah, I've been hearing that story for 15 years and money's going out and not coming in. How do we square that circle as an industry to make sure that this is still a category where capital is coming in for the right reasons, keeping in mind the time horizons that venture typically takes?
So there's a lot to unpack there. One, we're not just going to have IPOs potentially this year. We're going to have the biggest IPOs in the history of IPOs, right? So that's like, if you think about just zooming out, yes, there's a lot of problems, but a venture-backed business is going to be $1 trillion plus IPO.
Yes.
Right.
Agreed.
And there might be a couple of those. And so that's like, I think that speaks to the scale and the scope of the opportunity and how venture is changing, which is why everyone wants to be the access to get in those. But those kinds of businesses that can create that much value, that was not something that you ever even thought to underwrite as when I started in this business. The other piece of this is that, what is it, over $1 trillion plus is in these private companies outside of even those big ones, right? So, and you're seeing a new robust secondary market where people think of the IPO as liquidity. And I think but there's a lot of, I was just talking with an LP late last night, there's a lot of liquidity. And actually I got a distribution from a seed fund that was 30% of my original commitment yesterday because they are getting liquidity in these higher rounds. Yep. And so there's a lot of secondary activity and different kinds of liquidity. So it used to be, when I started in venture, 3 things. You die, you get acquired, or you go public, right? that's not, and those were the only paths,
yes.
right? Like there wasn't anything that would have step function on it. I do think now we're starting to see invest, secondary liquidity, pushing off the IPO to optimization. Some of them might even not go public. There might actually be, takeouts, buyouts, private equity is playing a new role. So I'm not trying to underscore or understate the liquidity issue. I think that's there, but I also think the market is kind of fixing it in that they're trying to meet that in a lot of different ways for LPs to get access to different liquidity.
Your advice to a 20 million fund like mine or a 50 million emerging manager is, hey, take the liquidity early in the secondary. No reason you have to hold till IPO. It goes against the conventional wisdom.
Or not all of it. Take some of it.
Yeah.
Like, I also don't think it's binary. Again, it's not like an all or nothing. This company, the fund that I'm an LP in, they weren't selling their whole stake. Right? They'd actually sold a little bit before, and in a bigger rate, they're selling more, so they still are holding on.
Yeah.
They're just taking some of that liquidity along the way. We've even done that with some discipline in some of our investments. So I don't think it is that binary.
Yeah.
And it's to your own needs and what your LPs want. And you have a different product. So I think we talk about all venture capitalists are not the same. Right?
We all have the same title.
When I was the chairperson of the NVCA, that was really hard, right?
Yeah.
Because I had to go and say, like, oh, I represent this small, like what you wanted to do is do the regional fund. So I'm doing this small fund that's in Montana that's bringing local jobs, while I have Sequoia and Andreessen, talking about TikTok so those were bigger issues that they wanted to talk about, but I also had to bring in the local drive to those economies. I think there's a role for your $20 million venture fund. I think there's a role for your $50 billion venture fund, but we can stop pretending that they're doing the exact same thing. And the LPs are going to pick different products, and there's going to be different liquidity requirements for each of those products. The last thing I wanted to say is that the timing to me is, I think, the biggest issue that no one's really addressing. Should these businesses, what is the timing of a venture fund? Should it be 10 years? Should it be 15 years? Should it be 20 years? When you should think about that liquidity. What does it really take to build a long-term business? I was reading something, there was the post Doug Leone's original Apple memo, which was awesome to read. It was great. But then it was like, did you sell? And it was interesting. It was like, well, our fund cycle was 8 years. So we had to sell because the fund cycle was coming up in 8 years at that period of time, right? And then we got to 10 where everyone was saying it's like, remember when I was started, it was 7 to 10. And then it kind of sneaked to 10 to 15. You look at SpaceX, like I was at DFJ when that investment was done, you're 20 plus, right? And there's a continuation vehicle, but that's an amazing business that it took that long to be that. So I think there's also going to be, in addition to just the venture capitalists and the LPs, there's going to be different kind of products that also have different kinds of durations. They're going to make sense for different kinds of founders. Yeah. And that's another thing that they should start to think about is like, what's the partner that I want that has not just like the skill set to help me, but also the same timeline or the same perspective of how they think about liquidity.
That's well said. I give this advice to founders a lot too, when they'll come in and they have a different growth profile. And somewhat pejoratively, I say, well, I don't know if you need to get on the venture treadmill. This is, a VC telling a founder, don't take my money, because sometimes founders are setting up for a very different kind of business. But what's starting to happen in venture is there's not really a capital audience for that right now. Just because we're in a moment of transition, I tend to find everybody is moving towards more and more of the power law as the power law becomes a bigger play. So I'm curious what you say to those founders. Is it just preserve optionality and get profitable and grow slowly? Or is there a product that needs to exist for the founders that are not going to grow 0 to 100 million ARR in the first year?
Yeah, I think that's the messy middle. There's a lot of that messy middle, right? We're seeing, and it's going to be interesting to see. There's a ton of activity of the seed, these AI native companies, and a lot of A and Bs at pretty high prices. And then there's, like you said, access to the ones that are kind of deemed the winners. Yeah. And that's not just through LPs, but that's also they're doing managed strategic accounts. The LPs are doing direct allocations of that. There's super high concentration in a couple of those names because they're not only concentrated in that they're investing in it.
Triple layer SPVs now.
They're also across all those different. I was again the LP I was talking to last night. He's like, we're across all these funds that are all across the same names. So that 80% is compounded. So the performance of a couple of these is going to have massive swing effects on the overall industry. That barbell strategy means that not a lot of people are willing to do the work in the Bs and the Cs and that incremental stuff. And no one wants to do down rounds. No one wants to do cleanup work. And so I don't know what's going to be all those AI native companies. Is that going to be another opportunity here? I think it's not like a general statement. It's founder by founder. Some of them should get profitable, right? Again, I use like Notion as an interesting example. That was like they were profitable to control their own destiny and then managed to actually re-accelerate growth after AI.
Yeah.
And they hadn't taken a lot of capital, and that discipline meant that they were primed where they could actually take that opportunity to meet that moment. There's a lot of companies I invest in on the healthcare side that you can use AI to streamline so many of your processes. There's opportunity for optimization across every company today. But if you're a women's health clinic, you're not going to suddenly start putting robots in to give, to help someone do a mammography, right? That's just not happening right now. Maybe there's opportunities downstream, but I think those are really important services for the industry. And so those you do have to think about how to control your own destiny, how to rethink the models, and look for different sources of capital that, aren't your traditional venture capital, venture capitalists. But yeah, the market, at the end of the day, the best founders usually find a way forward.
Now, 26 years of experience in venture, although you started quite early in your career, you've seen a lot of cycles, and we've talked about quite a few things today, whether it's the overcapitalization cycle that we're in, or whether it's healthcare and AI. I'd like to bring this back to you and Threshold. You have stayed really disciplined with your fund sizes at a time where a lot of your peers have raised exponentially larger funds. As you look out ahead, and I know it's hard to project 5 years into the future, but as you look out ahead, what does the future look like for Threshold? Does it look like the disciplined funds you're in today, or do you see an opportunity where you're running, multi-billion AUM books?
Yeah, thank you for starting that by making sure all your listeners know that I am old. And those of you on YouTube can see enhanced blonde covers the grays. In the same way we said that the founders have to be constantly iterating based off of this market and questioning assumptions, I think I have to do the same for Threshold and for myself in terms of where am I best at service of the founders and how does this model scale. I think one of the things is knowing where your superpowers lie and knowing what you're really good at and leaning into that. And we've always had Threshold's size drive strategy. And our strategy and one of our, what we SQLs for our founders is to be their first call. Right. We like to build these very, deep relationships with founders that can be very personal. I know my founders' kids. I know the challenges they've had. One of my founders was diagnosed with cancer. I was the second call after his wife. Right. And that's because we had to navigate what made sense for the company. I relish those relationships, and that's what I think I do really well. That doesn't scale. And I don't think I would be happy in a room with 20 people talking about, a tons of deals that are happening really fast. I want to say, here's a concentrated portfolio. How do I build the best businesses? And so I have to, I think I really do that. I'm partnering with people who are doing that. And how do we actually, find our mark in this, in this world, in this industry where we can do that in a way that's profitable for our LPs. We have to just choose our places very carefully. In the 26 years, I think there's been different phases. The first phase, when I really started DFJ, Tim Draper hired me. There's 10 or 15 firms that I felt kind of really mattered. And then there was some growth funded others, but everyone was doing a lot of different stuff. There wasn't there wasn't a playbook. You didn't hear, there weren't market maps, right? And there's ideas of how do there's the internet, and you had the idea that everything was going to change, but it was early on in terms of access. The democratization of the iPhone really changed that as a function, a step function of more people getting access, more opportunities. I wouldn't have ever thought of an Uber being a possibility until you actually you couldn't even think about that until you had the iPhone, right?
Yeah.
So this presumption that we kind of know how things are going to work, I think is really dangerous. And that was where you saw crazy big swings, like the SpaceXs, like the Tesla, in addition to, the Ubers, the marketplaces, all these industries, Airbnbs that didn't ever think that you could exist. I think we went through a phase then where it kind of became really predicated on a lot of cloud software, and everyone got a little too comfortable with it's almost it's easy, right?
Yeah.
You're going to invest, and if you come in at this, this price, you get to this revenue, you get this valuation, then you go public and this works, and at this scale you can go public. And it became more formulaic. There was still, great companies that were built with people, and I think Founders Fund in particular did a really good job of doing stuff outside of that box in there, but that was where a lot of the money went. I think we're back to almost that realm where we don't know.
Yeah.
Right. I remember reading Arthur Rock saying he'd been better off shredding every single business plan versus actually looking at it. And that's kind of what I feel like with these founders when I'm underwriting right now. I don't know what the future is going to look like. I know it's going to be really dynamic. And I want to find the kinds of people that are up for that challenge and can ride that wave. And I'm really excited by that. I know there's some challenges and negativity, but I think we've become too binary in our politics and in our every single statement. It's good, bad, black, white, AI, evil. I think there's enormous opportunities to rethink industries. I think our kids are going to have jobs that we couldn't even imagine.
Yeah.
And I want to make sure that we can continue with that optimism. I think at Threshold, if we can find the right founders and partner with them and convince them that they want to be part of our journey, we're going to do just fine. And I'll be really happy and rewarded at the end of that.
That is a wonderful place to leave it. Emily Melton, I am so grateful for the time that you spent and just all of the awesome stories you got to share here today. So thank you so much for joining me on Climb.
Yeah, thank you so much for having me. It was fun.